any questions, anything, ask them. Awesome.
I'm sorry. Well, good evening and welcome to Aldersgate United Methodist Church. We're so glad to see you tonight, and we also welcome everybody who's viewing online. Gosh, we ended up with another day of winter, so I'm glad that everybody was willing to come out tonight, even though it's Mother Nature's gone back to wintertime for us. I'm Carrie Beckenhauer. I'm a member of the Lasting Legacy team here at Aldersgate, and this is our second in our series this year about Money Matters. A faithful approach to financial planning. It's a chance for us to talk about stewardship and also to increase our financial literacy, which is always a good thing. A couple of housekeeping items before we start. One is that the restrooms are out the double doors. You just came in, left down the hallway. You'll see the water fountain. You'll know you're in the right spot then. We also have emergency exits on every wall. Not that we expect to use them, but just in case. If you brought in your coffee or your coffee cup or your glass, we're glad you did that. When you go back out, there's a tub in the fellowship hall where you can put your used item. So tonight our speaker is going to talk for probably 30 to 40 minutes. He's got a set of slides that he's going to be using. After that, we will open it for question and answer. I'll have a wireless microphone I'll bring around, so when you ask a question, the people online can hear what the question is. So John Dannenbring comes to us tonight as a certified financial planner, and you might be saying, well, what is that? And I'm here to learn about investments, and he's going to fill you in, so let's welcome John.
Yeah, thanks for being here. Thanks, Carrie, for the introduction. So I'm John. I am a certified financial planner, which meant that I had to pass a bunch of different exams all about financial planning, everything from investments, insurance, estate planning, all that jazz. And so what I do now, I own a wealth management practice that I run. My wife is a tax accountant. She helps me out with that for some tax planning. But I also teach personal finance at the University of Nebraska. So I have a class, Finance 260, with 80 impressionable young people trying to mold their minds into proper financial stewardship. And so just to give you a little bit of a background, you might be thinking, you don't know probably my age, but I'm probably not collecting Social Security yet. John, how did you get there? And when I was younger, I really became interested in investments at a pretty young age. Sometimes when I'm talking to a group of young people, they won't get this reference, but many in here may. I don't know, maybe 15 years ago, do you recall there was a commercial on TV for E-Trade? It had this little talking baby. I'm not sure if anyone remembers that. It was everywhere. That was, I was maybe 11 years old at the time, and I thought, oh man, that investment thing seems interesting. And I was interested in money at the time, and this was back when it wasn't that easy to invest your money. It was harder way back in the day, but it wasn't that easy then. And so I told my parents that I think I want to try this investing thing. It seems pretty easy, right? Just buy low, sell high. And so it seemed simple. So I had to scavenge a bunch of money together, and you needed $500 to open your first account, which was a lot for a 12-year-old. And so I got that, and then I said, I'm going to go learn about this investment thing. So I made some investments. I remember it was a Chinese travel trip company. It seemed great. It's called C-Trip. And in the first week, I lost half my money. Fell in love with it. Okay, I thought this is the best thing. And then throughout, I was reading books on the side, on top of reading the silly things that we would do, and as a freshman in high school. And at one point, I realized that the commissions I had to pay, every time I bought and sold a stock were a lot. It was like $5 every time, right? So it really eats into your return. So I said, well, what if a bunch of people get together? And what if I just charge a little bit of a fee or something like that? I don't know. And so at one point when I was in high school, I was managing my own money, some friends' money, some family's money, and some teachers' monies as they heard about these cool stock ideas I had and said, here, we'll write you a check, and we'll just see what happens. And so that was kind of my first foray into it. And then I was at the University of Nebraska, and I was really involved in the finance department. I eventually went out on my own to have my own practice, and then they heard at the university that I started my own business, and they said, we actually need someone to teach personal finance. We remembered you from school. They didn't do any other vetting, which I was a little bit surprised by, but I guess it's business worked out and said, will you come teach personal finance? And so this is great, right? We're talking about investments, but we are in a church, right? And we're talking about stewardship. And I really liked money when I was younger. But in college, I became a believer. And if you are at all familiar with the Bible, it actually has a lot to say about money. In fact, there's some research that would say it says more about money and wealth than it does about heaven and hell combined. So one thing that was necessitated was my view of money had to change. And as Jesus said, do not lay up for yourselves treasures on earth where moth and rust destroy and where thieves break in and steal, but lay up for yourselves treasures in heaven where neither moth nor rust destroy and where thieves do not break in and steal. For where your treasure is, there your heart will be also. And then he later says you cannot serve two masters. You cannot serve God and money. You have to choose one. And so that changed my view. I still like money. I wanted to deal with it, right? Like I said, yeah, that's true. It is a little bit funny there, but it has to be viewed as a tool, right? We're not called to a poverty gospel, right? You can't have money, but you want to use it as a tool. And I've seen it in different places I've worked. A lot of people with a lot of money, and they're very unhappy. Money will not be the cure for happiness, but it is a tool. So under that umbrella, let's talk about how to maximize it, okay? That sounds a little bit fun to me. So I'm going to keep going into investments. I didn't know what the crowd was going to be. Didn't know if it'd be young or old. But if you want, and I'll have this later, where you can take a photo of this, and it should pull up all my slides, all on a PDF that you can have on your phone, send it to whoever you want. You don't have to do it right now, or if you want to, you certainly can if it'd be easier to see the slides for you, but that's available. I didn't know there'd be any younger people here, and so I have some things geared towards younger people here, but again, they're the age demographic, there's probably no one under 40, which is fine, but you all probably know someone under 40. So you can take some of these slides, send it to them if you'd like. Last thing, because I teach at the university, I'm used to question and answer throughout the presentation. In fact, I even offer extra credit if they raise a hand and ask a question. Incentives work, okay? I've had numerous students say, wow, people participate in this class more than any other class, and it's because I bribe them. So at the very end, we will have just a full Q&A where a mic will be passed around, but if you have any question throughout, just raise your hand, ask the question. I'll repeat it back into the microphone so people online can hear what the question is, and we'll keep going. I also ask if people nod. Are we all in? All right, we'll keep going. So I like to show this example with investments to really hit the point home of how powerful they are. These are real numbers. Okay, but I use an example of a nurse and an ER doctor. And I'm going to show you how powerful it can be investing. I can explain out loud. So there's a nurse and ER doc. They both start college at the same time in the year 2000. The nurse graduates in 2004, starts her job. That's legit. It's a 4-year timeline. You start your job. The average starting salary in Nebraska, this is maybe a year ago, was around $60,000 for that nurse. And I said, what if the nurse was aggressive and saved 20% of her income for retirement? Not unrealistic. Aggressive, but not unrealistic. That's about $12,000 a year. I have an ER doctor. They have to go to med school, and then they usually go to residency after that. So the ER doctor isn't starting their job until about 2012. This is last year, about the average annual salary for an ER doctor in the state of Nebraska is around $275,000, and I have the ER doctor saving 10% of his income for retirement. And you might think that's a little bit low, right? Only 10%. Well, remember, it's over double what the nurse was saving. And I went through some math, and when I talk to medical professionals about this chart, they usually get a laugh. Just really quick, a little hand, are there any doctors in here? All right, probably not online. I can dog on them just a little bit. I love doctors, but I know people in my world, wealth management, that they sometimes don't actually like working with doctors because they have a lot of school, they get out and they make a lot of money, and so they start spending like someone who's been making that much money from the beginning, so they really aren't saving that much, and then they don't have that long to work, and so their money can't really work for themselves, and then when they don't have that much money in the future, they get mad at somebody, and they're going to blame the advisor, when it's like, well, you know, these are not unrealistic numbers for how much is left over to save in an ER doctor's life, and so by the time they retire, the value when they retire, the ER nurse, or the nurse has $5.7 million, and the ER doctor also has $5.7 million. So that's how, and I think these are realistic numbers, a nurse can have as much as a doctor by retirement. And the reason why is because the markets are powerful, investments are powerful over time, and the nurse had about 8 more years of her investments compounding on themselves. And so if you're saying, well, that's great, I don't have 39 more years. It's true. It creates a problem. But I can nearly guarantee you have people in your life that maybe do have some more time. And so these are the examples that are helpful on propelling the next generation forward and being stewards of what's been given to them. So another example here, I didn't know if there are any young people, maybe you have a teenager in the room and they would say, that's great, but I don't have a full-time job. I'd say, okay, what if you just put $100 a month in a savings account, or sorry, in an investment account? Got it invested in the stock market. Over time, the stock market's returned about 10%. What would $100 a month look like? And this little chart will show you, it comes out to a little over $1 million by the time they retire. $100 a month invested in the stock market. And once they get a job, they can even do a lot more. But that's the power of starting early. When I first was exposed to this, it was a professor in college who said, that's what the professor was saying, that's what his brother-in-law did. It was really smart. The professor, he said, I kind of wasted my 20s and early 30s, so I didn't start until I was 30, 35. As you can see, if you wait till you're 35, that's the line I just put up there, you really only have about a little over $200,000 by doing the same thing. If you wait till you're 40, 45, there's not a whole lot that's saved up. Starting early and letting those numbers compound is really powerful. So, if there's any questions, always feel free to raise your hand, but I'm going to talk a little bit about the stock market, what it is and what it is not. So what it is I think a long-term investment. What it's not is a casino. Many people think it's a casino, but I don't think it is. If you go watch CNBC, I like CNBC. I think it's good for some news. But remember, any headline online, they want your attention. They want you to either be scared or really excited. That's how they actually make money, right? They get your clicks and your eyeballs. So this is a common chart that you might see online about what the stock market looks like over time. And this is it. This is the U.S. stock market from 1930 to today. It looks kind of crazy. It looks like there's times where it goes really high, really low, but it does look like it's going up to the right. This is what I call a chart prime, because if you can see well, it's hard to actually see, but on the right side, you might have a growth from, these numbers are what the S&P 500 is, from 5,000 to 6,000, which seems like a lot on that chart. That's only a 20% gain. Whereas you might go from 500 to 1,000, which is a doubling of your money, but that size on the chart, the gain, doesn't look very big. Here's what the stock market looks like more accurately. It's something called a log chart. This means that at any one point, any change in the chart is the same across from the left or the right side. And if that seems kind of, what kind of math am I talking about? Just go with me. This is a much more accurate view of how the stock market's performed over time. That seems far more reliable and long-term, in a long-term investment, not a casino, where this looks a little bit more like a casino. And this isn't. Again, we're in a church. So there's a proverb, Proverbs 13, that says, wealth gained hastily will dwindle, but whoever gathers little by little will increase it. That's what that chart is, gathering little by little and increasing it over time. We're going to keep going. This is an actual slide that I used with my students at the university. The U.S. stock market over time, you don't have to look at everything here, and again, you can have the slides when we're done. Over time, it's produced about 10% per year. Okay? Now, every single year, though, it's not always like that, but over time, it's not really the average. It's something called the compound annual growth rate, which is more accurate. It's about 10%. Right? And as you know, the stock market, though, it's not always 10% every single year. This is the U.S. stock market's return every year going back to 1927. Blue lines are positive, red lines are negative. Remember that 10% number I told you about? That's where 10% is. There are very few times where the market in any single year produces about 10%. But over time, your return is about 10% annually. So as you can see, you're most often either way above or way below. And that's when it does get scary. Like I'm not going to lie to you, and you probably know this if you have had any investments. Sometimes it loses money and it gets really scary. But there are things and ways that I think you can overcome that. So we know that stocks don't always go up. Sometimes they go down. So how to keep your cool, as the young kids say, right? So how do you keep your cool? Data. I am a lover of data. So we're going to look at a little bit here. So what's going on right here is those are lines going up and down, positive or negative, for every year's return in the stock market, every 1 year. But now what it's going to do is it's going to look at, what about 5-year returns? Meaning you went forward a year and you looked back 5 years. What was my return? Go forward a year, look back 5 years, what was my return? There's very few red lines. Now let's go to 10 years. So you're looking back 10 years, am I positive in the stock market? Very few red lines, meaning negative. And in the 20 years, meaning that you looked back 20 years, how did I do? Go forward one more year, look back 20 years, how did I do? Was I positive? Was I negative? If you can't see it, or if you're online, you can't quite tell, or if the lines are really small, it was never negative over a 20-year period. Never. Not one time was it negative. And I have this up there, so they'll be in the slides if you want to look at it. Meaning, in any 1 year, it might be positive or negative, but over 20 years in the history of the U.S. stock market, you've never had a negative 20 years. You put your money in, waited 20 years, was it positive or not? 100% of the time, it was positive. I won't go into detail here. Whenever I see data like that, I always go, are you sure? And I like Excel, so I made my own chart with Excel, and I did all the math here, and essentially on the right side of the screen, as you can see, it was right. Over any 10-year period, 97% of the time you're positive. Any 5-year period, 92% of the time you're positive. And actually, over any 1 year period, 78% of the time you are positive, which is actually pretty good if you really think about it. But it can get negative, and as you saw from the charts earlier, when it gets negative negative by a lot. Usually people get really scared. But over time, it's quite positive. So even if you're in your, let's say you're sitting here and you're like, hey, I'm 65, I don't have much time to retirement. That's true. But let's say you have some investments that you say, this is my long-term investments even now as a 65-year-old. 10 years out, you have a 97% chance of being positive. That's quite a bit. It's quite a bit. Any questions so far? Anything that's come up? All right, I'm leading you on a primer here that over time the stock market is historically quite reliable. So I would say a goal of the stock market is you want to spend time in the market, not timing the market. Time in the market, not timing it. Meaning, if I showed you that over 20 years, you're positive, you stay in it, that's really worthwhile. I'm going to show you something that's kind of interesting. This chart is showing, right here, over on the left side, that was the bottom of the 2008 financial crisis. Stock market dropped like 50%, it came back. That was the bottom, and the stock market recovered, and it's been positive ever since then, from that point. But you might not be able to see it, but there's a bunch of headlines that I have listed there. Some of the headlines are, let's say this, in 2010, U.S. home foreclosures reached a record high in the second quarter. So let's say that you saw the stock market recover a little bit, but you see those headlines, you might be thinking, we're still in for a disaster, right? Home foreclosures, there's the record home foreclosures, this isn't stopping, but you would have been wrong because the market is not looking at a current headline, it's looking to the future. It's what's called forward looking. And so the market already realized that we were probably in an economic recovery before even the headlines said that we were. And that's kind of important. And it emphasizes why we want to stay in the market and not try and time it. So I made a chart that's kind of interesting. I just want you to look, there's this greenish line that's the highest one. That was saying you started in the year 2000 or 1999, you kept your money in the market. You had $1 million you kept in the market. You didn't get out ever. So you had a recession in 2000, you had another one in 2008, you had COVID, you had recent inflation, and what this came out to, this was the data I ran through 2022, you ended up with $4 million. Again, you went through one of the larger recessions our country's ever had, 2 of them actually, and COVID, and you came out 4xing your money. But I run this little example here with this orange line. In the 2008 financial crisis, I say, well, what if if things were going down and it was getting bad, and you stayed out of the market, and you sold everything, and you said, I'm getting out. This is too scary for me. And what I have showing there is that the market even did keep going down, meaning that you felt vindicated. You made the right choice. But then I have it that you never got back into the market until there was a headline towards the end there in 2011 that said the U.S. economy essentially is starting to recover. So if you waited all the way until then to get back in the stock market because you're trying to time it, instead of ending up with a little over $4 million, you ended up with $3 million. Just that one mistake of missing out on a little bit of growth cost you $1 million over, in this example, essentially 22 years. So for many of you, you still have 22 years on the horizon. And so you want to ask the question, do I want to make that mistake? And do I want to spend time timing the market or spend time in the stock market? And again, hopefully, if you think this is not worth your time at this point, I know there are people in your life that could be helped by this information, that you don't want to try and time the market. Don't treat it like a casino, but treat it like gathering little by little over time. I'm going to talk a little bit too then, right? We talk about the stock market, which is great, but I'm going to go one step further in actually, implementing these things that you learn. And you might go talk to different investment advisors, or you might see things online where, who do you even trust with your investments, right? How do you even go about that? And one of the things I want to point out is, it might seem really simple, and this is what I thought when I was 12 years old. Let me just pick good stocks. Just pick the good ones. Right? Carrie knows where I'm going with this. She knows what's going to happen. And let's say maybe give me a nod. You don't have to raise your hand. Have you ever heard of the S&P 500? You ever heard of that? The Dow Jones? Okay. So those are representations of the U.S. stock market. The S&P 500 is essentially the largest 500 companies in the United States. In my head, it makes sense. Why don't I just pick the best companies out of those 500? I'll make way more money, right? Just pick the best ones. Carrie knows. But the problem is, like I said, the market's forward-looking. So the market already assumes these bad companies, they're going to maybe keep doing bad, something like that. And so this is important. Why not just pick the best stocks? And this is the difference between active and passive management. So I think this applies for anyone, no matter your age, and applies to kind of a philosophy about your investments. Are you trying to pick the best stocks, or do you want to just pick all of them and let the good ones just do well, and the bad ones don't do well, then fine, so be it. So I just quick little primer. Active fund management. So have you heard of a mutual fund, something like that? If they're actively managed, that means that they're trying to pick the best stocks within some sort of index to beat it. Like I said, the S&P 500, 500 large companies, just pick the best ones, I'm gonna beat it. So if you hear, S&P 500, Dow Jones, we talked about that. Passive fund management, this is saying instead of trying to pick the best ones, why don't we just buy all of them and just see what happens? Just let it go. And if Apple's the largest company, then you give it more weighting in what you buy. This is called passive fund management. You maybe have heard of index funds. And if you haven't, but you want to share this information with someone, let's say a grandchild or a child, they maybe have heard of an index fund. If you're online, you probably have heard of index funds if you're at all interested in that. And so these are really two philosophies. What's better, just picking the good ones or the passive fund management? And Carrie might be able to back me up. Passive fund management, that's probably become popular in the last, what would you say, Carrie, 30 years? 20 years? Maybe. It's relatively new, but it started back, have you ever heard of Vanguard? The gentleman who started Vanguard, his thing was essentially, why don't we just buy all of the stocks within the S&P 500 instead of trying to pick the best ones? So I show this with a lot of students in my class. There are two things to consider, is that between active and passive management, there are cost differences. Active management typically costs more than passive management. It makes sense though, right? Because if you're paying for someone to pick the best stocks, you're gonna have a big team doing research. I know some companies, they fly people across the world to interview CEOs because they're trying to find the best stocks. But in order to do that, it's gonna cost money for all those plane tickets, right? No such thing as a free lunch. It's not free. And with passive investments, you don't have those costs, so they can keep the price cheaper for you as the end consumer. And performance, and this is the thing that surprises people. Again, it seems simple, just buy the best stocks. Well, unfortunately, active investments have actually underperformed passive ones over time. So the active ones, people with billions of dollars at their disposal to go do as much research as possible, over time typically end up underperforming just buying the market as a whole. You might be thinking, okay, well, how much do they underperform? And this is a screenshot of one of the best pieces of data that records all this. The S&P 500 I talked about, S&P, that stands for Standards & Poor's, they are essentially a data company, and they've been keeping track of this over time. I have a little note right there, and so when I'm in class, I tell students, hey, go look this up, make sure that you know these numbers for the exam. But I'll just tell you, what this is showing is that over a 20-year period, 94.3% of these funds that are trying to actively pick the stocks to beat the S&P 500 don't beat it. So that means it's 5.69% actually do beat the stock market over a 20-year period. If I'm going to roll the dice and say, hey, who would I want to attach my, my nest egg to? Do you want the, the investments that have beaten the other person 94% of the time, or the one that's lost 94% of the time? That's my opinion. But that's information that's really good to know that most people are not aware of when they're making some of these investment decisions. And I made this graphic for an article on my website, essentially showing that if you, this is just a chart of the United States, just graphically showing you the little spot down at the bottom, the little white area, that's representative of the percent of the United States, showing here's how many have outperformed the market. The rest of them don't. And that's really hard for people to grasp, that it can be so drastic, but it is. And that's important to consider. So that is my main primer on having what I would think is a well-researched philosophy on just even your investments. Information that I've had to struggle through to get to the point where I'm at, because especially when I was younger, right? I was 12 years old getting the stock market. If I found a way to make a buck in the stock market, I would have found it. I tried really hard. At the end of the day, when it's your long-term wealth, these are the types of data points you want to consider instead of buying individual stocks, in my opinion, that they may not do well over time, or at least trusting someone with your money who's buying individual stocks over time. So again, if I'm talking to a 20-year-old, they're probably in a situation where they can start making those decisions. If you're, let's say you're 85 and you're like, well, I've been doing this for, this is what I've been doing, it's been working okay. I'm not saying that you need to make a change. I'm not saying that. It's not like you're going to lose all your money by doing it, but it's information that I think I want you to know and important. So most people in this room probably know a little bit about bonds. If there is a group of young people, and I have 80 every semester, and I say, what do you know about bonds? You should hear the responses, okay? All over the place. One of them said, I've heard of savings bonds. And I said, what is that? I don't know. And I said, sound it out. He said, well, I guess you're saving something. I was like, exactly, So for most of those in the room, you probably know a little bit about bonds. So I won't spend too much time on them. In fact, in my class, I have a little example about Apple, how bonds work. I won't really get into the details. Long story short, I have an example of Apple. You essentially give money to Apple. I say you give them $100. You buy a bond from them. They promise to give you $3 every year for 5 years. And at the end of that 5 years, you get your $100 back. That's essentially the basics of a bond. And so that's what I teach a lot of these students. I say, this is the basics you need to know. One of the other things I ask them, though, is when you hear of a grandma that's investing, do you think she's going to want stocks or bonds? And a lot of them say bonds. And I say, why? And some of them say, I don't know. I just heard that. And I was like, well, good, you're onto something. Well, the reason is because it's viewed a little bit differently. They act differently. And so here's what I will tell my students. I say bonds, they are considered less risky than stocks. And they are. They're less risky, meaning you probably aren't going to lose 40% of your money in a year like you could in the stock market if you have bonds. Bonds probably won't do that. But as I've mentioned already, and I tell my students every class period, there's always a trade-off. No free lunches. Because you have that reduced risk, because it doesn't move as much, it's also not going to return as much as stocks do over time. If you want to return more over time, the price of admission is the volatility of the stock market. The price you have to pay is that it might go down quite a bit even in a given year. Bonds are a little bit different than that. They don't go up as much, but they don't go down as much. And the other thing too about bonds is that they tend to move inversely to stocks during economic downturns, meaning if stocks go down, typically, not always, but typically, bonds hold their value or maybe even go up in value. That can be helpful. I'm a master too in my job at fudge words, meaning I almost never say always. Not only can I get in trouble with the regulators, but as you know with life, there's always some exceptions, right? And we saw one recently. So what I'm just showing here, this goes back to about 2000, right before the 2008 financial crisis. The green line is the U.S. stock market. Blue line, those are bonds. And so that's why I show my students. I say, hey, let's go look at that little area right there, 2008 financial crisis. I zoom in, and the green line is the stock market. It lost almost 50% of its value at one point. The blue line, being bonds, held its value, if not actually increased a little bit. Bonds did its job, right? That's how it works. But it's not always like that. This is my however, okay, my fudge word. They aren't always safe, and they don't always protect you if the stock market goes down. So let's go look at 2022. That's where this little box is located. I was just about to treat this like a class. I was going to say extra credit. What was the thing that was happening in 2022? And I won't need the participation. Well, actually, does anyone know? Well, what was the big thing driving headlines bad for stocks?
COVID.
So COVID was 2020, and then what was after that? Inflation. Inflation was the big killer of the stock market, mainly because when inflation goes up, the central bank needs to raise interest rates to counter that, and it slows the economy down, stocks go down. That's one of the few times where both the green line stocks and the blue line bonds went down pretty much at the same pace, meaning those bonds that you thought were going to protect you, they didn't protect you in this one circumstance. Main reason I'm pointing this out is that there are always exceptions to rules. And if I say, stock market typically goes up, it's never been negative over a 20-year period, which we talked about earlier, maybe that'll happen in the future. There's a chance that we might have a 20-year period where it won't be positive. With this situation with bonds, this hasn't really happened for 40 years, since we had high inflation in the 70s. But it can still happen. And so, as I teach this in my personal finance class, I think it's important for everyone else to know bonds aren't always safe. They can be, and can be good, but they're not always perfectly safe. So, again, I didn't know there would be any young people in here, so I said, should you invest in bonds as a young person for retirement purposes? Again, this will be good. Easter's coming up, a few months, right? Month and a half. Start quizzing your grandkids. Go, hey, did you have bonds as a young person? They might say, what's a bond? You say, well, good, I went to this presentation. I know what a bond is. Should you have it as a young person? I get this question all the time in both my personal finance class and outside of my class. Should young people have bonds? If stocks are going to return 10% over time, and we've shown that historically they do over time, again, every 1 year might be different, but over time, 10%. Bonds even right now, this isn't the bond market of the 70s and 80s where they were producing 10% or more. Unlikely that they'll ever get more than maybe 4% on your bonds. And so if you're a young person and you have 45 years until you retire, or maybe 30 years until you might need the money, and we looked at the stock market being positive 100% of the time over a 20-year period, I'll present this information. And then what's still kind of funny is, and maybe you won't find this funny, but I'll look at the class and say nod if young people should have bonds, or shake your head if yes, and I get all the different answers. All the different answers. I would say no, right? If you're a young person, you want to be, and I would say, a wise steward of your money. If you know this money is for retirement and you won't touch it for 40 years, why would you pick something that is going to return less for you? It just doesn't make a lot of sense, in my opinion. Now, if you're in retirement or getting near retirement, that's when the conversation changes. Or if you're a young person and you have money set aside for a home, or you know that you're going to have, you're going to keep having more kids like our family is. Like, we want to have some money that's secure in case there's a disaster that strikes. Bonds can make sense. But in my opinion, no for young people. And I would actually even say something that you can even maybe for yourself look into. If you know that you're not going to touch your retirement money for 20 years, let's say, you should look in your retirement accounts and see if you have bonds that you're invested in. Because a lot of retirement accounts nowadays, if you get a new job, they'll automatically invest your money into something based off of your age, which is really a good alternative compared to before. I've heard some horror stories of people who got retirement accounts like a 401k, and they were putting money into it every month, and they didn't know that you actually still have to invest the money in the account. So they had years of the money just sitting there in cash, not actually growing for them. Nowadays, there's laws in place where they're automatically invested in something, but they typically have some bonds in it. So what I talk with young people is if you want to optimize your investment strategy, maybe consider having no bonds because you might not touch this money for 10, 20 years. And if you saw from the numbers before, over any 10-year period, 97% chance of being positive in the stock market. Over a 20-year period, 100% chance of being positive in the stock market. And again, we're in a church. If you've read scripture, they call it some part of basic hermeneutics. Hermeneutics is a fancy way of just like, how do you read the Bible? When they repeat things a lot in the Bible, that means you should probably pay attention. I've said that over a 20-year period, you're going to be positive 100% of the time. I've said that probably 7 times now because it's really important to understand that the long-term investments in the stock market really do produce quite a bit. And it's really something. So last little thing, I want to be mindful of time here, is, again, something that you can share with any young people. And again, remember, I'm actually here next month, if Carrie invites me back and doesn't kick me out, next month we're talking more about retirement planning. So if you want some like very retirement-specific questions, we will be talking about that next month. And I will say, with the personal finance class I teach, everything builds on itself. I start with knowing interest rates, and then I go from interest rates to knowing the stock market. Then I go from the stock market to retirement accounts, and they build on each other. A lot of things are geared towards those who are learning to invest right now. But next month will be more about, all right, I'm approaching retirement. What are strategies? What are things I need to consider if that's the case, to be wise stewards of our money? I get this question all the time. How much should I save for retirement, depending on my age? This is pretty good data that I've been able to find about when you're starting to save for retirement, how much should you be putting away when you're starting for retirement? And if you're in the age group about 20 to 35, the minimum that you'd want to be investing is about 10 to 13% of your income for retirement. What that would do is by the time that you end up retiring, with inflation and maybe even your job increasing, when you add Social Security to what you can pull from those retirement accounts, you should be in a pretty good spot. If you wait, though, until you're in your 30s or 40s, the number becomes a lot. If you wait till you're 45, which some people, depending on your situation, that might be your case, you might have to save 40% of your income for retirement if you want to end up in a good spot by the time it's retirement. And if you you guys know what taxes are like. You get a paycheck, you probably lost 30% right away to taxes, between 7.65% to FICA taxes, maybe some more if you're self-employed. If you have federal, you have state. Don't even remind me about property taxes. All those things eat in your paycheck, and then you still have to live, and then it's pretty hard to have 40% left over after that. And so this is what you would need, but this is pretty good. This is a good chart that I think is very helpful to a lot of people about when you're starting to save for retirement, how much should you be saving? So again, any young people in your life, people that are starting out, maybe you're here tonight and you are starting, those are some gauges that I think can be really helpful, good metrics. Okay, and I think I'm going to stop right there. I had a little bit more, but I don't think I've shown you way too many charts. I like charts. I like Excel, always have. At one point, I was able to use Excel, no mouse. That's pretty fun. You can do all on the keyboard, but I won't go there. So I will open it up for any question. Anything that you want to talk about, I will answer it. Just keep in mind, if you want some very retirement-specific questions, I can try my best to answer it here, but next month I'll probably have more charts and graphs and things that I will present on that.
Two questions.
Yeah.
First one, are you a fiduciary?
A fiduciary. I am a fiduciary, and to hold the CFP marks that I do, the Certified Financial Planner marks, you do have to hold yourself as a fiduciary. Now, fiduciary means that you essentially, on Scout's honor, say that I'm going to do what's in the best interest of my client at all times. What's unfortunate about that word fiduciary is I have seen people who I don't think they're fiduciaries say that they're fiduciaries, and it's really hard to tell. That's a really unfortunate thing about the industry. And so, you might say, well, how do you how do you believe me if I say I'm a fiduciary? There's things that you can do to mitigate conflicts of interest. So for instance, I don't sell any insurance. And I will say that's probably the biggest area where the fiduciary language comes up, because insurance products, including annuities, they can have some really big commissions, really big, like 7 to 10% commission. So if you think about it, someone says, hey, let's use a number, $1 million into an annuity, they might walk away with $70,000. There are a lot of really good people that sell annuities. But, again, we're in a church. That's why Scripture talks a lot about wealth, because it can make people do a lot of not great things. And so what I don't do is I don't sell insurance for that purpose. And I get my clients connected with someone who I trust to help them with insurance. So that's one of the things that you can do. And if you're evaluating somebody, maybe asking, how do they make money? How can we align interests? So that's my long-winded answer to your first question.
Second question, if I asked you to make my portfolio ESG compatible, can I make as much profit as opposed to non-ESG?
Yeah, so very good question. So ESG stands for environmental, social, and governance, and it is a way to view different companies that you'll have scoring metrics, let's say for each individual company. How do they do in regards to their care for the environment? Or is this company, are they dumping sludge into a river in some other country, and we want to be mindful of that? How do they do from a social and governance standpoint? This has been a long-standing debate for a while. And whether you can maybe exclude companies from your portfolio based off these metrics. I will say I've seen conflicting research on it. Some I've seen yes, and it's persuasive. Some I've seen no. I've seen it practically. I think the other hard thing is that some you have to ask, who's actually doing these scoring metrics and why. I think at one point, I remember seeing one where this is a couple of years ago, but it had I think it was like environmental on an electric vehicle company that was less than the social impact on from like Marlboro, like cigarette company. And there were just things where you thought, how are you actually scoring these things? And it's hard to trust. I personally would probably lean towards, I think you can probably do it, but there's no guarantee. So I'm not trying to dodge the question, but I'm a master at fudge words. So I think you can do it, but there's no guarantee. That's my personal opinion. Good question. And do you have a follow-up to that?
I guess I'm not one to drill, baby, drill.
Yeah. Mm-hmm.
I want to stay away from gas and oil, natural gas, ethanol. I want to stay away from that, mm-hmm. But I still want to make a good profit.
Yeah, and it's one of those where let's hypothetically say that let's say you stay away from oil, and let's say it actually does hurt you in the long run. It probably wouldn't be detrimental to your portfolio, but I think the question to ask is the value that you have in whatever that category might be, is it worth it to maybe have a little bit of a reduction in your portfolio returns, which might be a good metric on how much do I care about the issue, right? But I do think that you can probably exclude different segments of the market and still be okay in the long run. But that being said, depending on what you're passionate about, if you said, let's say privacy is the thing that you don't like, right? I know, unfortunately, there's a good chance that this thing was listening to a lot of my conversation. And if you said anyone involved with this that invades on privacy, I'm out, which people do. That means that you lose out on Google, you're going to lose out on Apple, you're going to lose out on Microsoft, probably, because they're in their computer. And at that point, you maybe have lost out in the last 10 years. Some of those companies have really been the main drivers of portfolio growth. And there have been others that have grown too. So I think it does depend on the specific issue in which you want to exclude and what that might do over time. Not investing in oil for a while was actually even a good investment. oil was not doing very well. But it did do a little bit better during the war with Ukraine, because now there was a lot of disruption in the oil market. And so some of these ESG funds that excluded oil were doing a little bit worse. But it wasn't detrimental, I don't think, to your long-term well-being. Yeah, can we do another? Yeah, you have a response. I mean.
I forgot my next question.
That's all right. If it comes back to you, though, we'll swing back around, and you can certainly talk to me at the end, too. Very good questions. What was your name?
Pardon me?
What was your name, sir?
EJ.
EJ? Thanks for the question, EJ.
Oh, are we headed for a financial crisis? Because one guy in Omaha says we're headed for the greatest financial crisis that I've ever seen.
For those online, the question was, are we headed for a financial crisis? Because a guy in Omaha said that we're headed for the greatest financial crisis ever seen. You're probably talking about Warren Buffett, right?
You are correct, sir.
There we go. Warren Buffett and his company, they are holding I think, $300 billion in cash, ready to deploy it when something gets bad. Now, they've been holding a lot of cash and making headlines for like that for 10 years now. And if you said, well, if Buffett's holding cash, I'm going to hold cash too, you would have missed out on a lot of return. And actually, in their annual letters, I wrote an article on this recently, Buffett even says, we're holding this cash because we're such a big company and we can, but most of most of the wealth of the company is still invested in both their own private companies and public companies like Apple and other companies. So even though they have a lot of cash, if Warren Buffett was so convinced that we're imminently going to be in a recession or economic collapse, they would have sold things by now, but most of their money is still tied in the markets. Very good question.
Yeah. As I asked what your thought is on mutual funds, particularly as it relates to diversification.
What are my thoughts on mutual funds and as it relates to diversification? I didn't have that in the presentation. In my personal finance class, I actually talked about that quite a bit. I think they are phenomenal. A mutual fund is a way that you buy essentially a fund where you and a bunch of other people pool your money and you're buying a bunch of other stocks. What I'll do in my class is I'll have students look up a bunch of different companies and how much each share price costs. And one of them is actually Berkshire. Berkshire Hathaway A, I believe, is at $700 and some thousand, one of their shares. Now they have a way to make it easier to buy, but what I tell the students is, let's say you have $1,000, you might only be able to buy a few stocks with that money, but if you buy a mutual fund, it's a good way for your $1,000 to be split up into hundreds, if not thousands, of different companies. There is a competing product to them called exchange-traded funds that I think are better from a tax standpoint. That's probably beyond the scope of this presentation, but in general, the idea of mutual funds getting your money diversified into owning a lot of companies, phenomenal. One of the greater inventions that's happened in the financial markets is the mutual fund.
John, I wanted to ask about if you're talking about stocks generally returning 10% and bonds generally returning 4%, could you talk about the rule of 72? If I go to talk to an advisor down at US Bank or somewhere, and that person starts talking about the rule of 72, what are they talking about? Yeah,
the rule of 72. It's a helpful way to look at how much your money will return over time. The rule of 72 essentially says, I'm going to talk about some math. Let's think of a fraction, right? You have a numerator on top, denominator on the bottom. If I want to look at how fast or how long it'll take for my money to double, if you put the number 72 on top and divide it by your expected return, let's say stock market's 10%, just put 10 as a whole number. So 72 divided by 10 is 7.2, and that means that your money generally, at a 10% return, it'll take 7.2 years for it to double. So I don't know what the number is. I'll take my calculator out because I'm not a math whiz, even though people say, oh, you work with numbers a lot. I let calculators do it all. But 72 divided by, let's say, 4, the return on bonds over time, how long would it take for your money to double? It'd be 18 years. So instead of your money doubling in 7.2 years, it'd be 18 years for it to double, which adds up.
So if I put my money in a savings account that's making 1%,
I almost did the math, 72 years, and that is something where when I'm teaching my students, and which many of you in here probably have had this from learned experience, but if you're going to look at, let's say you have some money and you're like, well, I don't think I need this money now. I don't know when I'll need it in the future, but I can let this just keep growing. I sear into their brains 10% stock market return over time, 10% over time, because savings accounts rates, those change, right? They were essentially nothing. They went up after interest rates went up, so you maybe were getting 4%. Now you're probably at 3% with a really good savings account. You might be getting a lot less. And so I want these students to know, well, if you have money that you're comparing your return on, 10% or 3%. And so that's why I want to sear that into their brain when they're making those financial decisions.
John Bogle started the first index mutual fund in 1976. So I just saw an ad the other day. It said Vanguard 50, because it's their 50th anniversary of when the organization was founded.
Yeah, and that's the thing where I think what he created with Vanguard and the index fund, I think, is one of the great ways that people have been able to get their money invested in the stock market and be participants. If you really think about it, it's really kind of crazy. I can go, and again, technology is so good, I can go and buy a part of numerous companies and be a part owner and be able to take part in the wealth generation of companies, which, as Carrie, you mentioned about your parents, they weren't able to do that, or if they were, it was really expensive back in 1920. It was really expensive to do it. Even in the 1980s was still expensive to do, but now it's very, very affordable, which is great to, So are there other questions?
Other questions for John?
Oh, there's one in the back.
I'd like to get your perspective on the current political regime, in the sense of there's a lot of activity going on with tariffs. And my question is, are those things we need to be concerned about, or should we ignore them, or are there things that we should do?
Very good question regarding tariffs. Well, if you recall, and I'm watching the news all the time, so if I mention something and you think, oh, I don't remember that, it's part of my job, right, to be watching this. This tariff regime that came out was around April, and it was very aggressive. And the people I know that are in supply chain, they were saying it wasn't even necessarily that there were tariffs. The challenge was how quickly they came. And essentially, you had 90 days to make an adjustment. I have a relative who works for a company. They do deliveries with scooters, like electric scooters. And they already were looking at how can we change our supply chain to not be so dependent on China. But they can't do that in 90 days. You need to be working with different suppliers, and you're going to be spending time testing it out. So it might take you 2 years, right, to actually update your supply chain. That was the big issue with tariffs, was how quickly they would be implemented. And it was about a week, and the current administration, they backed off of, not necessarily backed off of tariffs, but how quickly they would implement them and the steepness of that. So since then, there still are tariffs in place, but as you can see from the U.S. stock market, it hasn't hindered it necessarily since then. I would be more concerned on if tomorrow you wake up and there's a headline that says, there was a tweet last night that President Trump said that we're going to have 200% tariffs on everyone else, right? That would be pretty detrimental. I think, in my opinion, I think the lesson was learned. Don't do that. And my understanding from the political insiders that I occasionally know or read about online is the current administration, for better or for worse, they do watch the stock market, and if it responds poorly, they change course. So not terribly principled, but that's the way it is. I don't make the rules. So I would say in the long run, I'm not terribly concerned at where it's at right now, but I still want to watch it.
Other questions for John? We have an expert here, so this is a lot easier than trying to reach somebody by phone or emailing and waiting for an answer. So if you have questions, let's ask John.
I'm reluctant to say this, but I was raised on a farm, and I knew what AI was many, many years ago. Do you know what I'm talking about?
You're talking about a horse?
A horse or a cow.
A horse or a cow, yeah.
Mostly cows.
Yeah.
Well, the term AI, artificial intelligence, of course, is one of the top subjects I watched an interview with the new Disney CEO tonight and the old Disney CEO, and they were talking about AI. In your opinion, and this is a tough way to look at it, but what's it going to do to the average investor? When I say average investor, whether it's young or old or whatever, how are we to make sense out of AI? The corresponding question, not in direct relation, but it's probably the other one that most of us think about, and that's the security, the ability to protect your investment or to have other people protect it. And perhaps the two are much more related than I would like to think, but I can't follow AI, nor can I follow the security risks, and I have to hire somebody else to do that.
And when you're talking security risk, just to clarify, are you saying security risk that something maybe gets hacked and then the money gets sent somewhere else?
Yeah, I'm doing it on a personal. That is my nest egg safe where it is?
Yeah, it's a very good question, and I will say I have many debates with many people about AI, both from even just its societal impact to from an investment standpoint. And people often will say, well, what's the nearest example we have? And people will look towards the internet. Internet's done a lot of great things. Societally, I would probably lean towards it maybe is actually a net negative between what it's actually caused in the lives of, I would say, people across the board. It might be a net negative, but the aspect of technology is that it's going to be here and we have to learn to adapt and put safeguards in place. That was the internet. When it comes to something like artificial intelligence, you're right, Larry. I have a tough time keeping track, and I'm in this all the time. The good thing is we can be patient, because it was 2 years ago when AI really came on the scene, where you could interact with this chat bot and you could say, hey, write me a poem about my cat and my backyard on a sunny day, and it would produce an okay poem. And that was kind of when people said, well, this is really interesting. It's only been 2 years, and we're at the point where some people can connect AI to their computer and say, clean up all of my emails, send emails to these people, use my own, like how I typically write my emails, and get it onto my calendar, and then send me text reminders. And it can do that. That's a pretty big difference, where we're at today versus writing poems 2 years ago. In terms of security, I take a much more conservative approach in that I'm not installing AI programs into my computer. I might use a web browser that connects to one, and I'm connected over the internet, but I'm not installing it on, let's say, my phone. The good thing about, the dangerous thing about cybersecurity, the bad guys are using AI, but so are the good guys. And there's always a battle, and that's been a thing forever with cybersecurity, is that the good guys come out with something that's new. A disgruntled employee says, I want to make a bunch of money, so I'm going to take out that new thing, and I'm going to talk to these bad guys over here, and let's use that thing that we developed now to counter them, and it's this big cat and mouse game. The way that a lot of systems are set up now, there's so many barriers in place that unless you are yourself hacked or fall for, I call it like phishing schemes, right? You get an email and you think it's from your friend and you click a link and then you don't realize it, but there's software now on your computer. Outside of those situations, I'm not terribly concerned yet about the security. Now, maybe I will be. I'm watching it all the time because, like you said, it changes. I'm not terribly concerned unless you're actively, putting programs into your computer and letting it do things, because I've heard some pretty scary stories about that. Okay.
So what I'm hearing you say, perhaps, is don't get too worried about it, but do the sorts of things you can do. Triple authentication. Perhaps not taking down a QR code. That's been discussed here recently.
Yeah, I would say now. Oh yeah, go ahead.
Yeah, well, I'm just saying there are things that we probably can do that I'm not sure are valuable, but they could be, and I think we have a duty to do those things too. It's a matter of due diligence with yourself.
That's a good point. It's due diligence, right? So if I have a QR code and you click the link and you go, oh, this is Alpha Omega's personal, it's their drive and you can download it. The due diligence is, I'm here, here's my full legal name, and if I'm doing something bad, it's pretty easy to sue me. You can go look me up on the Lancaster County Tax Assessor's website and you can find out where I live, right? The danger is if you get an email from someone that you don't really know for sure, or if, let's say you get an email from me, but it's not actually me, and I say, hey, click this link, you might want to call me and say, hey, is this actually you, John? Honestly, the scary thing though, is how impressive the fake voice is. That's becoming a really scary thing, and even the fake video.
So you're really John?
I'm actually. You can touch me. Yeah. But those are things to be. I got an email from a client that they had a new email. It looked legit. I called them. And I actually even said some things that if it was someone trying to fake being them, they probably wouldn't have known the answer. And it was my client, and they weren't trying to do something crazy, but you just have to be very, very mindful. Anything electronic at this point, you do. So if you see a random QR code just stuck somewhere in downtown Lincoln, stickers, don't open it up and click on that.
I agree.
Yeah. Mm-hmm.
One last question.
Just this last week, I saw that Britain was making some arrangements with China to do business, and there was other countries were making plans with India, Vietnam, South Korea. They're all going away from the United States because of the current climate. Can you reflect on that? Because China has been thinking about things for a long time, and they're very strategic and sneaky in some of the stuff that they're doing. It's been in the news for the last couple of years about how they implant things into the cell towers that are by military bases and stuff like that. So with our traditional trading partners going to China, how does this all affect what we've been talking about tonight?
That is a very good question. And one of my favorite pastimes is just watching geopolitics. I think it's interesting. Carrie knows this, but my mother was actually a ballerina in Europe, and she came over in the U.S. after the fall of the Berlin Wall. And I have a keen interest in Poland. That's where she's from, and Warsaw in particular. And so because of that, I like knowing what's happening, right? I think the challenging thing about some of these different trade moves that is a lot of times it is actually political, and what we see might only be 10% of the story. I know someone that works in national defense, and they often will laugh and say, the story that you read in the newspaper, it's only 10% of the story because we sent someone that we know doesn't know anything about whatever the topic is to go talk to the press. The people who do know what's going on are just going to keep their lips shut. So for instance, let's say Canada, they had this meeting with China recently. There is some aspect of, is this like a risk where they're going to essentially allow the Chinese, get away from the U.S. and allow the Chinese to be their primary trading partner. Personal opinion, and I've seen this before, sometimes that's just a chess move where they'll tell the U.S. we're serious about doing this, and so behind the scenes, someone else here goes, okay, all right, yeah, hey, let's actually we can make a deal, and it'll be something like that. So for instance, like Europe, the EU commissioner was talking about maybe doing something more with China. That was a big headline. I was watching a little bit deeper, the non-headlines, but what people were talking about. A lot of other people in Europe said, no, we're not going to do that because of those risks that you just talked about, which is we know that they're pretty sneaky on what they do and that there's typically an ulterior motive versus let's just have a good trading relationship. So the other thing to consider as well is administrations come and go. That is part of it. Is in fact, one of my friends went to Yale, and he had a friend who was from China, and pretty high, if you're going to Yale and you're from China, you come from a pretty wealthy family. And one of the things he said is that one of the things that we kind of admire, but it's kind of a detriment for the U.S. is we can pivot pretty quick. With an election, we can pivot, whereas another country like China, you can't really pivot. You can't make a change so fast. Well, you can, but let's say your leadership's going down a bad direction, you're kind of stuck. You're stuck on that. We have elections every 4 years for the presidency, and every 2 years there's other shakeups. So I personally am not terribly, I'm not terribly worried. I know that there's a lot of Europeans that they still know at the end of the day, we need to make sure we keep good trade relationships between the European Union, US, Australia, Japan, South Korea. I mean, even just, I'm not sure if you saw it today, as much as a deal was made between India or China, there was just a deal struck with a tariff announcement that India is going to stop buying Russian oil. Could that be just a chess move? Maybe. Or is it actually what's happening? So I think there's a lot behind the scenes that we just don't see, and ultimately I think a lot of things are just chess moves. Do you follow up to that? Yeah.
China owns a lot of our debt, and that's an issue too. And then they have spent a lot of time infiltrating into our universities. So, but the debt thing, I mean.
Yeah. So China owns a lot of our debt, infiltrating universities. I would agree. I think that is a concern. It's a concern, but a lot of people own a lot of U.S. debt, and I don't know the exact numbers. They own a lot. I think we might own a lot of Chinese debt too. I'm not entirely sure. Don't quote me on that online. But I do. I mean, those are part of the larger scheme. I don't think that we're in a situation that China owns so much of our debt that we're beholden to them on if they want us to do anything. From different policy experts that I look at that have an economic lens, that's not terribly much of a concern. A bigger concern might be if the Chinese yuan becomes like the global reserve currency, but I think that's highly unlikely. But we'll have to just keep watching that. But it is a concern. So do not let me say, oh, these aren't concerns. They are concerns. But there's a million concerns, there's a lot of things to be mindful of. Last little thing, Carrie, is, for instance, in the U.S., let's compare, let's say you have investments in the U.S., right? The things that you have to be worried about. For my parents, my mom, who inherited a really tiny apartment in Warsaw from her mother, there's a non-zero chance that part of our risk analysis is that there's a missile that flies into them if the war in Ukraine expands. And from my friends that knew some information when they started the Ukraine war, there was legitimate talks that Russia said, maybe we should show the world we're serious and drop a tactical nuke on Warsaw. And so that's a part of analysis, right, that we have over there. I don't think anyone's ever said, is my apartment in Des Moines going to get blown up by the Russians? That just isn't. And so I think that's one of the things that, despite a lot of issues in the world, we have a lot going for us in the U.S., mainly because of our oceans and our peaceful neighbors to the north and the south. That's my opinion.
Okay, let's wrap this up and thank John for being here. John's going to be here next month. He's going to talk about retirement. So especially if you have young people or people still working, well, what do I do with the 403B? What's my choice for my 401k? What do I do with an IRA? How do I do something with an IRA? Do I take it down and put it in a savings account in the bank and make 1%? Well, we just heard that. That's probably not what we want to do. So
Social Security, I will talk about that. Or if you're going to be here next month and you have ideas, hey, would you talk about this? I probably have a slide on it or a presentation I can do. So come up and tell me that this is a topic that you would like. I'm happy to do
we want to thank John, and we'll see him again next month. Thank you, everybody, for coming.
Thanks for being here.